Hey everyone, welcome back to SBA Unlocked. I'm here with the TrueLiant SBA lending team, and we are all things education for your 7A loan process. I am here with Cora Robinson, SBA loan specialist, Rohan Ansari, an SBA BDO, Nathan Walker, SBA underwriter, and Shem Dupay, SBA loan specialist. Today, we're going to be talking about a pretty interesting subject. We handpicked everybody here for this. It is going to be about commercial real estate hack, leveraging the SBA 7A loan for 100% financing. I am going to kick it off with you, Shem. The question that we had was, what are the pros and cons of buying versus renting in the 7A?
Oh, yeah, good question. The first one is probably that it gives you security and peace of mind. So many of the commercial real estate deals that I look at are typically the landlord is selling the property and the tenant that is inside of it is at risk of losing it if they don't buy it themselves, and then they have to relocate, which can disrupt their business. So the nice thing about that, a lot of times I'll work with borrowers that have relocated 2 or 3 times in the last 5 to 10 years, and it totally disrupts their business. So securing your own property and owning it yourself can really give you the peace of mind that you can be stable and or grow without having to disrupt your operations.
Yeah.
So that's probably the primary one. Beyond that, you are obviously going to own an asset. So instead of renting from a landlord, you will own it. And so that appreciation will be your upside if you buy it. So those are probably the 2 biggest ones for me.
There's also like I don't know, like a retirement plan succession aspect to it. Like, let's say you're running a business, you buy the building, 10 years later, you decide, I don't want to run this business anymore. I'm tired. I'm ready to retire. You can sell the business, keep the real estate, and then start earning rental income in your retirement years too.
Yeah, that's very interesting. Actually, didn't typically think of that, so that's very interesting. But on the flip side of that as well, if you do end up selling your business, I always think that it's a stronger business if you can sell it with real estate. So there's also that if you do decide to sell your business later on, you're selling a business with real estate. It's just kind of a nice package deal instead of having a lease that's about to expire when you buy a business and then you have to go find a new place. So it kind of falls back into that same thing of having that security. You're getting kind of a package deal.
Another experience that I've had is I've actually had a borrower buy the building and actually had some other locations from other businesses that were occupying the real estate that was not occupied by our borrower. And he was actually able to buy the whole real estate since his business occupied more than 51% of the real estate. And he actually now gets the rental income from that, as well as he was able to buy his own location. So it's a 2-in-1 for him. So he's got his own business location bought, and now he's got the rental income coming from the other tenants.
Yeah, I actually had a similar one. This is actually for my brother. He wanted to purchase a building for the first time for his business, which was growing. And he was going to be able to operate out of 51%, largely warehouse space and some office space. But the couple other suites that were in that building were actually enough to essentially pay for the loan payment for the CRE altogether. So it was like a wash. So he was going to get a building, be able to operate out of it, and essentially the tenants that he had, which, again, were minority of the building, were going to pay for that loan payment, which is pretty amazing. So pretty sweet deal.
From a credit perspective, CRE is also value add for the portfolio as well. So
Yeah.
almost in relation to owning it from an investor standpoint.
Yeah, that's also a very good point because as I was mentioning earlier, there is, when you go to sell your business and you're selling it with real estate, that'll be potentially more easier to finance if you're selling it. Probably easier if you're trying to buy a business with CRE as well. So I feel like the CRE component when it comes to business acquisition strengthens things. I think credit likes it better. So it could give you more desirable terms for the business acquisition. Yeah. So yeah, there's a lot to like about that. And I think, the credit perspective is something that might get missed.
Yeah, I mean, more times than not, we're going to be fully secured or pretty close.
Right, yep.
So Rohan, why would someone use an SBA 7A loan over 504 conventional financing?
Yeah, generally there's a couple advantages of using a 7A over a 504 or a conventional. A couple would be loan for real estate are going to be you generally qualify for a much higher LTV than a conventional loan will offer. So we generally go between 90 and in some cases up to 100% LTV. Another one would be there's no covenants and there's no renewals, so you don't run the risk of having a renewal in 5 or 10 years. And also if the market conditions change, You don't run the risk of the bank calling in your loan. You are in that loan for the length of the amortization, which is 25 years, and that's not going to change.
Now, one thing that I think might be important for potential borrowers to know about the 100% financing is I feel like it sort of implies that you're just going to have a collateral shortfall. Maybe we'll discount it to 85% of the actual value. And so there's 15% of unsecured portion. But the thing that borrowers should know is, well, if there is no other available collateral, yes, we could still potentially 100% finance that. But the SBA does require us to take all available collateral until fully secured. So that might mean that we have to place a second lien on your primary residence till we get fully secured. So there are times where we might not be fully secured and still could 100% finance, but there may be other collateral we end up having to take to get to 100%. So just kind of keep that in mind, I guess.
It also, the difference between 504 and 7A is the prepayment penalty too. So if you're in a high rate environment, and you want to potentially pay down that loan, pay it off, do a conventional loan later down the road, you have a 3-year prepayment penalty on 7A, and I think it's 10. I want to say it's 10 for 504, right? Look at all
Don't
7A
know.
lenders.
Yeah.
None of us know. I think it's 10 years.
I know it's 3 for
Yeah.
for 7A.
It's 3 for us, but it's 10 for 504. So I think that's another thing, is if you're sensitive to rate or prepayment, things like that, you just kind of have to choose your poison.
So Cora, what is a typical profile of a good 7A real estate candidate?
My favorite 7A commercial real estate candidate is someone who is looking to buy the property that they're currently renting, but they don't have the money for a down payment. And their business is doing great, they're cash flowing, but maybe they just don't have enough money to put down towards a loan. That is a perfect 7A fit. Maybe they need a little bit of extra money for improvements too. That's something that we can throw in there. Hey, you want to purchase this building and you also want to, I don't know, remodel the office space, and that's going to cost you $120,000. Then we can add that into the loan. Oh, and you also need a little bit of working capital because you want to do X, Y, and Z with your business. We can add that in. And so now all of a sudden, you're not only buying the real estate, but you're getting all the funds you need to really spruce up your business, and all at 100% financing. So
And on a 25-year term.
25 years, yeah.
So yeah.
That's all. I mean,
does
it get better than that?
And I also don't disagree. That's the perfect scenario, is just a straight rent replacement. And you could even sometimes throw in a debt refi if there's a little bit of debt that's not on great terms, similarly to the working capital. And again, on a 25-year term, it's going to really increase your cash flow. So
That sounds like 180 months right there. You keep throwing stuff.
yeah.
25 is gone.
Yeah, that's true. It does have to be 51% of use of proceeds.
51% of the loan, not the use of proceeds. That's a fun thing. It's the 51% of the loan has to be used for real estate. So but I guess in this case, if we're doing 100% financing, it's the same thing.
Yeah, it'll be hard to get to beyond 51%.
Yeah.
But
So actually, back to you, Nathan. Are there any properties that are not eligible for SBA financing with commercial real estate?
A specific property I am not quite sure of outside of occupancy. I've never really came across any particular piece of property that was ineligible. But if it was ineligible, it wouldn't really be on my desk.
well, while it might not be ineligible, there are definitely some commercial real estate properties that could give you hell in closing and potentially die from environmental issues.
Yes.
Like, some manufacturing could have some deep, dark secrets, that you'll find in the environmental, or gas stations or laundromats. So those are eligible, just to be clear, but you could definitely run into issues with them with environmentals that could get into a phase 2 or remediation. Not to scare anybody, obviously, but it's something to keep in mind that can get expensive if you do run into it. So, and I think it's like manufacturing, dry cleaning, and gas stations. Anything with like oil and gas require a phase 1 environmental right out of the gate.
Now, the one thing you can't do is you can't buy an empty lot, let's say, and then build on it in the future. That I know is ineligible. So I've dealt with that a couple of times over the last few years.
And then also I get a lot of phone calls of, hey, I want to buy this office and I want to like sublet it all out. That's not eligible. It has to be owner occupied, and at 51% has to be owner occupied by the business owner or the borrowing company. And then if it's new construction, it has to be 60% now, right? Or it's always been 60%.
The 40-60 split sounds about right.
40-60 for new
Yeah.
construction, and then 51-40, at least 51%.
Yeah.
So that's something that I feel like we get a lot of questions on the front end as someone who's looking for an investment property. SBA is not meant for passive income.
Yeah, basically anything triple net. You get brokers that ask us for, hey, can you quote this deal? But if, like Horace said, if it has anything, if the majority of your income is coming from renting and letting the individual spaces within your real estate, it's obviously not going to be eligible. And I think that's something that a lot of people miss on when trying to find the place or trying to find a place for an SBA.
Yeah, I mean, SBA doesn't like that so much that even like a barber shop is considered ineligible because it's like renting the chairs out. So that kind of, they really don't like, the fact that you're even able to rent out 49% of your building is kind of, nice that it allows for that, because generally speaking, the SBA does not like
It's
renting.
a generous leash.
Yeah, it is. Yeah, and like I said, that can be huge. I mean, you potentially pay for your whole loan payment just on that. So that's about as far as it goes, though.
What about franchises that are like salons or barbers for commercial real estate?
Generally, would be the business itself would be the ineligible piece. So kind of separate from the real estate. It's sort of just drawing an analogy between the fact that barbers and salons will often rent their chairs,
Right.
and that rental income is ineligible, with some very specific exceptions, but generally
Yeah.
speaking, it's ineligible.
Like
So that
W-2 employees, I think if it's W-2 employees, then
Right.
salons are eligible. But I thought they changed it in the new SOP though.
there's some specific, like really specific carve out language where you could get it done, but it's like too specific probably to go over. And generally speaking, it's still largely ineligible if you're renting out a chair. So
Regarding the franchise piece of it, Emily, I think when we have a franchise, like a barber shop or something like that, I think we really don't run into the rental model or the chair rental model, where they're more so of having W-2 employees providing the service rather than providing the rental. And another aspect of it is the franchise has to be on their franchise registry. So if they're making income from renting out barber chairs, they're likely not going to be on the franchise registry. So I think we probably wouldn't run into that problem too much when it comes to franchises.
Question to you, Shem.
Sure.
What are some of the properties you might be surprised to hear are eligible for SBA financing?
most, as Nathan was saying, most are eligible, but I think the one that kind of fits into the conversation we were just having is that comes to mind to me is hotels, because a hotel is kind of a rental, weirdly. So you would think that wouldn't be eligible, but it's considered short-term rentals, similarly to self-storage, which is the other one that comes to mind. So you wouldn't think that those would be eligible based on everything we've just said. But the SBA wants to see that quick turnaround. It's not long-term rentals.
Yeah.
So if it's short-term rentals like storage or hotels, then it is an acceptable use of proceeds, or is eligible. So yeah, those are the two that come to mind to me as like surprising, given how much the SBA doesn't seem to like rental income.
Marinas and RV campgrounds are eligible, but there's very specific rules about them. But they are eligible. It's like it has to be transient, and a certain percentage of revenue has to come from X, Y, and Z. So there's specific rules, but it's eligible.
Does anybody know why a hotel is eligible but an Airbnb is not?
From what I understand, is they're providing more than just a space, and it's not passive. You actually have to have employees come in and clean the rooms and be present at the hotel to check them in, provide concierge services. So there's more going on than just checking in, checking out.
And so, Rohan, this question was for you: is what are the one or two biggest things that can kill a CRE deal?
There's quite a bit that can kill a CRE deal.
What are the biggest ones?
But the most common that I will say are an appraisal coming in low from the purchase value, or an environmental coming back with potential contaminants that could trigger a phase one, potentially phase two, and like Shem talked about it, environmental problems are very, very expensive and they take time.
I had a deal where, I mean, it took forever to structure this deal. This was 3 years ago, and it took forever to structure. The borrower, the seller, everyone was working with us. It probably took 6 months to get it where it was at. And what killed it? An environmental, because there was a phase two issue. It needed to be, basically, all this dirt had to be taken out, scooped out because it was contaminated, and then backfilled with clean dirt. And it was going to cost, I think, $70,000, give or take, on top of the
Man.
30 to 40,000 they already spent on environmental reports. And so they were like, "We're done," and the seller ended up financing it, because that's how difficult environmentals can be in a real estate deal.
That is somewhat crazy though, because now that new buyer has that problem.
Like, why
and
would
can
you
never
want to
sell it.
buy
Yeah.
Yeah.
a dirty property
it's
on
not
the word
great.
that the seller is going to clean it up and you've already transferred the deed?
Yeah.
But
Yeah, I have a friend who's a commercial real estate guy, and he just bought a property, and it was like it's supposed to be a two package deal by basically by two properties. So there's one guy, but one of them had a known environmental issue, and it was going to be about 200,000 to remediate, which is obviously a lot of money. So the guy was like, "If you buy this other property, which is clean, I'll just sell you this one for like $5." So they got that building for $5. They've put 200,000 or so into it to remediate it, and now they're trying to sell it to the tenant that they have there now, which, Lord willing, I will be financing.
That's awesome.
hopefully it's
So,
clean.
and it should come clean. Yeah, I just keep asking them, how's that environmental looking?
Yeah,
So
make
the-
sure to order that early.
Yeah, exactly. But I do know about it now, which is great. So it's not something that's going to scare me and make me cry in closing.
Nathan, does the geographic market come into plan when financing a CRE transaction?
In two scenarios, if it's an expansion, right? So they're going from one location to a second into potentially a new market, or it's a startup, which I think we pretty much shy away from. So yes, but if they're already in the market, they're already monetized in the market, the customers, etc., they have market share in that market. No,
Yeah.
not really. I mean, there's one-offs, right? If you know that that particular area is in a sort of declining trend for numerous reasons, then yeah, maybe. But more times than not, if they're already in the market, it's a pretty easy calculation.
Yeah, I had some experience with that on a deal that we couldn't get home on. That it had commercial real estate, but it was in a rural area, fuel delivery. So it's essentially a going concern, which basically means that the property can only be used for like one thing, like a bowling alley or whatever. So the question is like, what is that property really worth if this business goes out of business? It's in the middle of nowhere, fuel delivery, but if what else could it be, right? So it might be valued at $1 million with a business in it, but what if that business doesn't do well? It's not, in a downtown location where it can just become a restaurant, right? So that does factor in as well to the decision-making process, and that was part of the reason why we couldn't get home on it. So
I think other two things is, if you're looking to do a USDA loan, then that's when the geographic area comes into play. And then when you're buying a historical property and want to do any improvements on that property, SBA has very specific rules on how to go about that. So those are a couple of other examples.
So Nathan, how do lenders view projection-based loans for businesses buying real estate to increase their footprint?
Yeah, so that's going to be more like an expansion loan request. So you can either apply the 115 historical requirements, or you can do the expansion requirements where you're at 0.75. It really just depends. So ideally, I mean, it is, if you are expanding, it is going to be somewhat of a projection based deal, but you want to see historically the existing operations, existing sales, et cetera, market share, however you want to describe it, can at least suffice those minimum reduced coverage requirements for an expansion, right? Because we can't really charge them, if you will, for sales that they haven't been able to create, right, in a larger space. So
what is like realistically the likelihood? Of course, we're talking CRE here, so you're doing expansion, and they are buying a building, and they're going to obviously populate that building. Let's say it's not a restaurant. It's
Yes.
not a restaurant. It's something else. What is the likelihood? You'll probably be not fully secured, but close. Will we look at that 0.75 instead of it, or are we going to want to see it be at a 1-to-1? Obviously, we want 1.15 minimum. But realistically, what can that projection-based cash flow look like with being kind of almost fully secured, if not fully secured?
Yeah, well, I mean, I think that's going to be lender specific, right? So, I mean, with fees and the SBA guarantee, closing costs, et cetera, you can sort of exceed that full securitization LTV sort of
Mm-hmm.
metric or whatnot, but by small margin. In regards to projections, yeah, you're going to want to see the 115, right? And so that's in regards to the total debt, the existing debt, and
Mm-hmm.
any sort of obviously the project debt as well. On
Mm-hmm.
a projection base, yeah, you're going to want to see that 115. But historically,
Mm-hmm.
right, to further expand, if you want to exclude, let's say, for example, our note, and they're at 115 or greater on their existing debt, yes.
Okay.
Then you include our note, right? So
Mm-hmm.
holistically, you're factoring all debt. Then we want to see the minimum 0.75. And again,
Got it.
some lenders can sort of deviate higher to that, hopefully not lower. Um, so
Yeah, and presumably the CRE really helps get that done because it's obviously we're taking a big risk as the lender with the projection based financials, but with it being largely secured by the real estate, that probably goes a lot further than just another expansion loan that is not secured by much, maybe a little bit of equipment or something, I would think, right?
yeah, I mean, being fully secured on a first lien basis, deed of trust on CRE, it's always a plus.
Yeah,
It's always a
yeah.
benefit,
I,
regardless of the loan request.
I had an interesting scenario where it was a vet practice and a boarding facility in one building, and they were expanding down the street. They owned the lot, and we actually were able to use the lot as their equity injection. They had owned the lot, and they were like, "Hey, we want to build a vet practice on this." So it was ground up construction, but they built the practice on it. Their existing grooming service, boarding service, and vet practice could debt service this new practice that they were about to build, or it was close to it. Like, it was pretty close. And they were going to refurbish this facility to just do grooming and boarding and not just to be their vet practice. And so that's where maybe if it wasn't cash flowing perfectly or if it was close, projections would come into play.
Well, I mean, projections are always going to come into play, but historically, you want to make sure that they're achieving those metrics both pre and post sort of project debt on the 115 or greater, and then the 0.75, and then 0.85 really if you wanted to go special use. But again, I haven't really been seeing that applied in the last couple of years. So again, I think it's lender specific. So
You guys, thank you so much for answering all these questions about commercial real estate. I know that there could be some lingering questions for anybody who viewed in today. So if you want to send us an email to sbaunlocked@truelionfcu.org, you can specifically reach Cora, Rohan, Nathan, or Shem with any of your questions. And we do have a couple more of these coming up, so we will see you next time.